Depending on the transaction, cash flow is probably one of the most important parts of the underwriting process for the lender. Financial institutions are looking for primary cash flow from the project and then a secondary source of cash flow from the people. When you're dealing with primary cash flow, you're looking at the cash flow available to service the debt payments of the project. You're trying to identify the historical net cash flow after paying all the operating expenses, adding back any add backs such as depreciation, one-time expenses and or interest expense, and possibly rent expense if they're not staying in the place they are renting. The secondary source of cash flow is the individual's personal cash flow. What is his or her cash flow from their other personal income and assets they have? By secondary, the lender is trying to identify what happens if the primary cash flow goes away. Will they have a second place to go if the primary cash flow completely is eliminated? Let's say that a business owner is buying a building for $1 million. They're going to put down 10% and will get a loan for $900,000. The rate is 4% with a 25-year amortization, so the payment is $57,610 a year. You look at their business and their revenue for the last year is $400,000 and his operating expenses were $200,000. Furthermore, he has a few equipment loans for $50,000 and his interest expense is $10,000 for the year. He pays rent at the current building of $50,000, which he will not be staying at when he buys the building. You run his cash flow and take his net income, $200,000, which is the $400,000 minus the $200,000. Then you add back interest expense. You're also going to add back rent expense of the $50,000 and even depreciation if it's in the profit and loss or not. This will give you the cash flow available to service the debt, which is $260,000. He has $20,000 in equipment payments and his new debt service is $57,610. Together, the total is $77,610 in annual debt payments. The lender is then going to take the $260,000 and divide it by the $77,610 to see what the debt service coverage ratio is. It's 3.35 times. That's great, seeing they really only need 1.25. Now, let's say that you get a copy of his or her personal tax returns and their personal taxes show they only make about $100,000 in income, and they have outgoing debt payments of $150,000 a year. You now see that they have a negative $50,000 every year that they have to pull from somewhere. The only place that they can pull from really in this situation would be the business. So what do? You would then decrease the business cash flow by another $50,000, taking it to $210,000 versus the $260,000. The reason for this is that somehow they need to have the ability to obtain cash to make up the shortfall. This is just one example of many that focuses on how important cash flow really is. Let me give you a rundown of the project types and what they look for in terms of cash flow. New construction investment would be projection-based cash flow in looking at the leases they do have signed or future leases. They will look at the comparables to see if they can support the future rents they believe are possible. Small business startup or expansions, they're going to look at the existing personal cash flow and also the projected business cash flow. The focus here is to see if they have the knowledge and the competency to pull off their projections. And finally, the existing income properties will look at the historical cash flow based on profit and loss statements. And they'll also look at the apartments, office, retail, industrial, and many, many more. And remember, the cash flow is huge when it comes to underwriting. And as soon and very, very soon, you will begin to understand how to perform this analysis.